In India, mutual funds have become a popular investment option. Yet, many investors are unaware that they can use their existing mutual fund portfolios, even those not performing well, to secure a loan. A loan against mutual funds allows investors to borrow money by pledging their mutual fund units as collateral. This can be a useful option during financial crunches as it provides access to funds without the need to sell investments. Here's how it works and its pros and cons. To be eligible for a loan against mutual funds, you need to be an Indian resident over 18, holding open-ended mutual funds registered with agencies like CAMS or KFintech. When you take a loan against your mutual funds, the lender temporarily locks your mutual fund units as security until you repay the loan. Once your loan is approved, the lender will set a limit on how much you can borrow, usually 50% of the mutual fund's value for equity funds and up to 80% for debt funds. The loan amount can range from Rs 25,000 to Rs 1 crore, depending on the lender and the value of your mutual fund portfolio. One major advantage of a loan against mutual funds is that you don't need to sell your mutual fund units even if they are underperforming. This preserves your long-term investment goals, allowing units to recover when markets rebound. For example, if your portfolio is in the red due to a bearish phase, selling would lock in losses, whereas a loan keeps your holdings intact. Interest rates for loans against mutual funds are typically lower than personal loans or credit card debt, making it a cost-effective option. Since it is an overdraft facility, you pay interest only on the amount utilized, not the entire limit, offering flexibility. The process is quick, often completed online in under 15 minutes, and requires minimal documentation, appealing to India's tech-savvy populace. Additionally, you continue earning dividends or capital gains on your pledged units. However, there are risks associated with loans against mutual funds. Market volatility can shrink your portfolio's value, reducing the loan limit and triggering a margin call which requires you to repay part of the loan or pledge more units. Failure to comply could lead to the lender liquidating your units, potentially at a loss. The loan-to-value ratio restricts borrowing to a fraction of your portfolio's worth, which might not suffice for large financial needs. Not all mutual fund schemes are eligible for loans, as banks often limit loans to approved funds, excluding some smaller asset management companies. Moreover, while interest rates are competitive, they are higher than those for loans against fixed deposits or gold. For Indian investors, loans against mutual funds can be a smart tool to bridge short-term liquidity gaps without derailing financial plans. In a culture where gold and real estate are often seen as primary assets, pledging mutual funds devoid of emotional baggage feels pragmatic. However, it is not a one-size-fits-all solution. Disciplined borrowers with stable cash flows benefit most, while those over-leveraging risk losing investments in volatile markets. Awareness is key, as many investors overlook this option and default to costlier loans or premature redemptions. As fintech companies push for digital adoption, loans against mutual funds could reshape how Indians view their investments, not just as wealth creators, but as financial safety nets as well.